Hi, I'm Mike, and I'm the Chief Investment Officer here at Lighthouse Financial. And today I'd like to put a ribbon, a bow on 2024. So I'll start sharing my screen and let's commence our market update. December 2024, this is the last day of the year. You'll be watching this right after the holiday. Here are our talking points for today. We'll size up the markets. We've had back-to-back 20% plus years for the S&P 500. In general, the stock market in the US has done very, very well. The Dow is up 16% this year for this second year in a row as well. These gains were driven by the AI boom, a very orderly presidential election, and a resilient economy. But I think we probably need a correction to reset some valuations, and I'll get into that a little more. We'll talk about rates and inflation. Rates are restrictive and do present, I think, a risk to the economy. Inflation, however, is a bit sticky, and it's not coming all the way down to where the Federal Reserve would like it to be. So investors are asking, is the Fed going to pause rate cuts? I think there's a lot of fear out there that they'll commit a policy error that could really knock us off our high horse this year. We'll talk about opportunities and risks as well. Look, the economy is very resilient, as I said, but we do expect some slowing this year. Corporate earnings, I think, are top of mind for the first time. We don't have to just solely focus on the Fed. Finally, corporate earnings are doing well, and I want to point that out. And finally, fiscal and trade policy. I think this is one of the risks, but also an opportunity that we'll talk about. Fiscal meaning government finances, and the trade war really referring to the proposed trade tariffs. All right, so we've had two very unusual years back to back, great returns, and you see this chart going from the lower left to the upper right. You gotta love it. S&P 500 is up 65% since the bear market bottom of October 2022. Along the way, though, you see the normal corrections. On average, we get 10% correction, per year. Didn't quite get it this year, but close, had a 9%, and that's considered totally normal. The rally has really been driven this year by Mag 7, or the Magnificent Seven, the seven biggest stocks. So that's, NVIDIA and Tesla and Microsoft, Amazon, and so forth. So those big high flyers accounted for about half of the S&P 500's return this year. And what about the other 493? Well, that's what this chart's all about. The Mag 7, just those seven biggest stocks, returned almost 68% this year. That's a crazy amount. 68%. The other 493, excluding that Mag 7, up only 16%, which is right in line with what the Dow returned. So a huge gap, and we really thought that last summer we were going to see a big broadening out. In other words, more of a rising tide lifts all boats kind of an environment with stocks. And for a while we did. The other 493, or the predominance of the stocks in the market, started to do a little better, industrials and financials in particular. And that lasted from mid-July to November. But this month it's the tech companies just taking over again. So it makes you think, are we a little too expensive, or at least are the Mag 7 too expensive? And to judge that, a lot of investors use a ratio called the price earnings, or PE ratio, which says simply, how many dollars do you have to spend to buy $1 worth of earnings? And with regard to the Mag 7 stocks, the green line, you have to spend $31 to get $1 of profits from the Mag 7 stocks as a whole. So that's very high. A PE of 31 is extremely high. Now, if you look at the blue line, that's the other 493 stocks in the S&P 500. and their PE is only 19.5. Just to give you a little bit of context, the S&P 500 itself, just looking back in time, the average PE ratio for the index is 16 to 19, somewhere in that neighborhood. So the other 493 are not completely dislocated, right? They're kind of in line with the high end of the long-term average. But Mag 7 stocks are trading at a huge premium, and mostly because Mag 7 stocks last year and then expected again in 2025 have very, very high growth rates, not just high sales growth, but specifically high profit growth rates. And when I say earnings as the price to earnings ratio, I mean profits. That goes back to the fact that stock prices tend to move with earnings and earnings growth of an individual company or an index. Maybe Mag 7 deserves to trade at 31 just because of that very high growth rate. It is true that you can have a whole stock market or an index or an individual stock trade very expensively for a long time. It does not mean that a big correction or crash is imminent. It just means that as you get more expensive, as the PE ratio gets higher, you're a little more vulnerable to a shock that might come along, like a trade war and tariffs, and knock you off your high horse. So I'd like to say one more thing about this phenomenal back-to-back 20% plus year for the S&P 500. This has only happened, I think, 8 times in the past where you've got 2 consecutive years with 20% plus returns. In 6 of those 8, the third year was positive, not nearly as good, but still positive. And I think the average return in the third year in 6 of those 8 times was about 12%. So this is definitely not to say that if you have 2 very strong years, you're in for it, right? Because historically, we have every reason to believe, just looking at odds, that it could be a decent year. But as I said, as you start getting more pricey in the market, the stocks start getting more expensive, you are a little more volatile, usually a little more vulnerable to volatility, to ups and downs. And so whereas we didn't have a 10% correction last year, it's hard for me to believe that we won't this year. And so I do predict a little more volatility. Let's turn the page a minute and talk about interest rates and the Fed. I am almost sick myself of talking about the Fed. But whereas earnings are the single biggest determinant of the direction of a stock or the stock market, interest rates are the second biggest determinant. So got to talk about it. The orange line, and you've seen this chart before, the orange line is the Fed funds interest rate. Finally, last summer, the Fed felt good enough about its progress fighting inflation to start reducing interest rates. And so you see that orange line step down. It's come down from 5.5% to 4.5%, so a full percent lower, which is great. But at the same time, the blue line, which is just traders, investors in the market trading the 2-year Treasury note, they're actually raising the yield. At the same time, the Fed is lowering its rate. The 2-year Treasury note yield is rising. Now, the simplistic hope, is that when the Fed lowers interest rates all through the economy will fall. But it doesn't always work that way. Markets are always fluid. And so right now, if you just sort of take away this chart, if you're a trader as well, I guess bond traders don't believe that the Fed will be able to continue dropping interest rates in 2025 at the same rate that they did in 2024. So in other words, fewer interest rate cuts in the future. Well, why is that? There's 2 reasons, and the first is progress on inflation, and the second is growth. So let's handle these one at a time. Here's the progress on inflation, and this is 4 different lines to just 4 different measures of inflation to track the trajectory. We've chopped a lot of wood since 2022 and brought inflation way down, right? But over the last few months, progress on inflation is kind of stagnated, and we're not moving any closer to that dashed purple line, which is the Fed's 2% long-term goal. So, you know, if the Fed doesn't see continued progress toward 2%, or inflation actually kind of turns around and moves a little bit higher, that is a deterrent for them continuing to lower interest rates. So right now, you know, I think the last speech from Fed Chair Powell acknowledged that his view of where inflation was going, at least in the short term, kind of fell apart. I want to just for a second, I want to step aside and say, you know, inflation, obviously most of the time, guys like me are looking at inflation as a percent change in prices year over year. But the way my clients look at it, the way most people look at inflation is this way. I took this out of the Wall Street Journal using BLS and St. Louis Fed data. But this just shows prices of things that we use every day now versus pre-COVID. So, you know, compared with pre-COVID, it basically says the cost of electricity for Americans all across, well, in aggregate, is up about 30%. 30% since pre-COVID levels. That is pretty high. Same thing with food. If you've been to a restaurant lately, it's still shocking to you, I'm sure. And so, you know, this is a strain on the economy, and some of these services, especially like rent or car insurance, you know, they're sticky. Inflation is sticky, and it's not coming down as fast as I think the Fed wanted it to come down. And that just means they're probably going to have to alter the pace of rate cuts. Maybe we get fewer next year. But that's a problem, because if you get fewer rate cuts, that means, you know, it tends to mean that the interest rates stay pretty high. And I think the Fed is correct when they say current level of interest rates are restrictive. In other words, they hamper growth. Look at bank rates. Average 30-year mortgage has come up from 6.5% to 7.25 just in the last, you know, couple of months. Credit card interest rates, despite the Fed lowering interest rates a little bit on their end, credit card interest rates have not come down. You can see them steady around 20%. So it's a drag, and it's a drag on consumers. Higher rates are also a drag on companies, and I think that's one of the reasons why there's such a big divergence between stock returns of the Mag 7 and the other 493 in the index. You think about the impact of higher rates on commercial real estate or housing market or manufacturing. Those areas in the US economy are not doing well. And so these rates are restrictive, and we do over time need to see them come back to normal in order to continue this rally, in order to continue the business cycle. And I think they will. But here's another reason why the Fed might not be able to cut rates as quickly as it wants to. We looked at inflation, but now we got to look at growth. And this slide really gets to the core of growth in the US economy. How are we doing? And it's the consumer, because the consumer, and specifically consumer spending, accounts for, you know, 70% of the economic growth in this country. So I'll just say this: the job market remains healthy. It really does. I know a lot of headlines you're seeing are sort of chicken little headlines, and the sky's going to fall. But unemployment is still under 4.5%. And not only that, the blue line here shows that consumer spending is growing at a 5.5% annual clip, and wage growth is growing at a 4% annual clip. And both of those rates are above the rate of inflation right now. So consumers are in pretty good shape. That usually augurs well for the rest of the economy. And that's another reason why the Fed, you know, may not be able to lower interest rates all that quickly. I think one of the best things we have going for us is acceleration in corporate earnings. And this chart is one of the reasons why we never called for a recession throughout 2022 or 2023. Certainly not this year, because corporate earnings is really what you care about if you want to guess at the trajectory of the stock market, the long-term trajectory. So this black line goes from the lower left to the upper right, and it shows a consensus of Wall Street analysts, people whose job it is to predict the future corporate earnings. And they go company by company and they add it up, aggregate it at the index level. So this is forward 12 months, guessing what's going to happen in 12 months. And the guess is basically that the S&P 500 companies will grow profits by 13 to 15% next year. That's almost twice what you could expect in an average year. So it's really good to see. One of the prime things we have going for us. And the higher this goes, the better off the stock market's going to be in 2025, and the less volatile it will be in 2025. Okay, so you can tell our outlook is that we're probably going to have another positive year. It's not just looking at history and the sort of almanac factors. It's also looking at the fundamentals. We're trying to look at the forest rather than the individual trees a lot of times, and what are the overall trends. But so I'll tell you what I think the main drivers or opportunities are going to be, and then we'll acknowledge some of the risks as well. I think the economy may continue to surprise. Look, economists have done a terrible job over the last several years projecting economic growth, and they've continually had to raise their estimates. And so, maybe the trend continues next year. Maybe the economy, which is supposed to slow from 2.7% growth this year to 2.1% next year, maybe that doesn't happen. Or maybe it slows from 2.7 to 2.5, and all those numbers are healthy, by the way. So I think it's a real possibility. We could get continued investment in AI that really continues to drive the stock market, and that would probably primarily benefit the Mag 7, but I think some of those benefits are starting to trickle down. We're just in the first stage, which is building out the infrastructure so that these big corporations can then build apps and tools to increase efficiency for everything we do in life, and also provide these tools for consumers and generate big demand. We haven't seen that yet. So that's the next stage, and 2025 should shed some light on that. Next, as I said before, earnings growth should accelerate, and I think we could even be underestimating earnings growth if the next two bullets come to pass. So hear me out on this. I know a lot of people disagree with me. I think the Fed is a proven hand. I think they've proven in the way that they have engineered a soft landing, and they've proven that they're very sensitive to not only the inflation side but the growth side of the economy. So I don't think they will commit a major policy error this year, and that should help earnings growth. But also there's a possibility that the Trump administration could, through deregulation, spark business activity. Certainly, that did happen during the first part of the first Trump administration. So that could help us as well. On the other hand, let's acknowledge the risks. We probably need a valuation reset for stocks. Didn't have a 10% correction this year. We know that's normal. Probably will have it happen this coming year. And a valuation reset is great for not only resetting sentiment, you stop having everybody chirp at you about how overvalued everything is, but it also could bring us a more long-lasting rally. Next, again, to AI. It's possible that AI does not live up to the hype. It's possible that there's a come to reality moment when we realize that all of the expectations for future growth for NVIDIA and some of these other companies may have come too high, too fast, and need to be ratcheted down. And in that case, you are going to see a correction with the Mag 7, and that will bleed over into the index just because, Mag 7 is such a big part of the S&P 500 to the point where I think a lot of investors are wondering if they can even use the S&P 500 as is any type of a benchmark in the future because it is so concentrated now. I think we probably will get at some point in the year a growth scare due to higher rates or a trade war. There are a number of things that could bring about a growth scare, and we sort of had one actually this past summer, and that was the 9% correction that we got. And finally, earnings could be hampered by a strong dollar, and I think this is a probability. Some of these are possibilities. I think this is a probability. That having a strong dollar at the macro level is great, right? The U.S. economy is growing faster. We are a more dynamic, innovative economy than in Europe or in China. And in addition, Europe's dealing with too many wars, and China is dealing with a real estate crisis, and their growth is actually slowing. So we're sort of the cleanest shirt in the laundry. We got our own issues, but we're doing better, and that tends to make the dollar stronger, and that's good, except if you are a multinational corporation selling your products overseas, a strong dollar makes your products less price competitive. And so you think about like a Whirlpool or a Nike or a Pepsi, and you start to realize, gosh, the dollar has strengthened a lot. This could hurt profits. And so I think we're probably going to get some evidence of that when companies start reporting fourth quarter earnings in the new year. Overall, I would say, for us, the scales are probably tilted toward the opportunity side, definitely. But I must say that, I think I'm feeling a little more uncertain about the trajectory of things than I did 12 months ago about 2024. I want to talk about some lessons, deliver some lessons for 2025. This is kind of lessons for us as we sit around the shop and think about investing next year. And here's where this comes from. Most professional investors, economists, investment strategists have been wildly wrong over the last couple of years in terms of growth trajectory, inflation trajectories, what the Fed might do, and then what stock prices would do, and then price targets for the indexes as well. Just wildly inaccurate. And so I think in an environment like this where uncertainty is rising and everybody's been wrong, everybody's been whipsawed, you got to stick to your long-term investment discipline rather than chasing short-term trends, because some of these trends that we've seen have been ultra short-term or driven by sentiment that just was misguided or projections that were misguided. So you got to stick to your guns, stay long-term oriented, and do not focus on the next week. And that feeds into my next lesson, which is don't overreact to daily headlines or individual data points. I want to give you an example of one I heard this morning on CNBC. A reporter said this: the S&P is trying to avoid its first 4-day losing streak to close out a year since 1966. Now that sounds ominous, right? 4-day losing streak, and all the way back to 1966. It makes it sound like something historic and negative is happening. In reality, that stat is absolutely meaningless. It's counterproductive for people to even think about it. It's irresponsible for a news media outlet to even mention it. It means nothing. And the problem is that it misdirects people's minds away from what really matters. And that's what we're trying to do with these market updates, is counter that. We're trying to focus on the things that we believe really matter and push aside the noise. My last lesson for 2025 is this: remember, Even a big drop in stocks can be purely temporary when driven by sentiment and positioning. Don't let it provoke you to overreact. Sentiment and positioning are not fundamentals. They're not, economic growth. They're not sales growth or profit growth for a company you're investing in. Sentiment and positioning change. I think we can agree that the NVIDIA trade might be overcrowded. That's a positioning issue, and that may have to be self-corrected within the market next year. I think we can agree sometimes that sentiment is overdone one way or the other. I think sentiment in late 2024 with regard to healthcare stocks was overly negative based on what the Trump administration might do with policy in the next couple of years. So those healthcare stocks that were hit by negative sentiment could very well be propelled forward in 2025 when that evaporates. That's the thing about positioning and sentiment. They're very, very temporary and they can evaporate. So we got to remember that in the face of volatility, which I do expect next year, we got to be true to our strategy and stick to our guns. I want to thank you for watching. Wish you all a happy new year, and we'll see you next time.